It's all physicians. Let me tell you the bad, okay? It's all physicians. And that's our Alliance for Physician Leadership and our healthcare management program. Those programs are growing. So you only can get into those programs if you're in the hospital area. Plus, we have a corporate program. And this is where I think a lot of FEI corporations can benefit. We'll come in and we'll do a little bit of an overview of your organization, and we'll specialize anything you need. UTD, as I mentioned previously, has a lot of knowledge and know-how, and we continually grow. Last week, for example, Bloomberg Business Week ranked the UT Dallas Jendale School #1 in learning outcomes. And we are very, very proud of that. So if you have any needs at all, feel free to reach out to me at john.barden@utdallas.edu, or feel free to call me anytime on my cell number, 607-759-0918. David Springate, a lot of us know David in FEI, right? He's been the founder of our executive MBA program. For more than 25 years, he's served our program admirably and is currently our academic director. David is also the co-founder of the Center for Finance Strategy and Innovation. David is a tenured professor of finance, and his focus is primarily on private equity, corporate renewal, international finance, and innovation in all areas of finance and the equity markets. So David, I'm going to turn it over to you to talk to us today about what happened with GameStop and the future of our equity markets.
Thank you, John. And on behalf of myself, the center, and our panelists, I want to welcome you to this program. We hope it will be productive for you. The setting for this is that these are new developments in the financial markets, and the center has always seen itself trying to get into what's happening, what are the new developments. So we see, starting perhaps early this year, this rise of the meme stock, the GameStop. Everybody's talking about GameStop. Everybody's talking about AMC, the way the democratization of finance is evolving. Anyway, what we wanted to do at the center, and we have done, is pull together a panel of experts from various perspectives and get their take on what's happening, why it's happening, and what the implications may be for corporate finance and for the future of financial markets and associated areas. And I think we've got a good panel to do this. Now, the way we want to proceed here is that we will have a series of directed questions at the panelists, trying to get their take on the topics as I have outlined. You, the audience, will be able to submit any questions you have through the chat, and at some point we will bring some of those questions, take some of those questions to the panel. Towards the end, we'll give the panel an opportunity to react to everything they've heard and the questions that have come their way, and ask them for closing comments. And the one other thing is during the program, we will have the polling questions come up, and we expect that the timing of that we'll try and make it work along with the general flow of the program. So at this point, let me introduce the panelists. Our first panelist is Dory Wiley. He's the CEO of Commerce Street Capital, and he brings the perspective of both investment management and investment banking with his firm to this program. He has served as chair of the investment committee of TRS, and we're glad to have Dory. He often speaks publicly, and we're glad to have him here. The second panelist is Ron Nash. Ron is a partner in the Nash Technology Group and brings the perspective of a seasoned technology executive and government advisor at high levels. Not only has he been involved at a high level of our Department of Defense, but he's been very high level at EDS and Pro Systems before then, and now we have the Nash Technology Group. He's also been active in venture capital, served on private equity firms. Ron is well qualified to be here. Our third panelist, Gil Sadka, colleague of mine, professor of accounting at UT Dallas. And he's very active in asset pricing. He's published in the area, and he's well known in that area of asset pricing. And we're glad to have him. He brings a nice balance to this perspective. And the fourth person on our panel, Elizabeth Jones, our Associate Director of the Center for Finance Strategy Innovation. She co-founded the center along with me a number of years ago. Elizabeth has a long history of consulting and financial leadership around the issues of especially governance and improvements. So the Baldrige Awards and being a fellow of the National Association of Corporate Directors, that's all part of Elizabeth's bag. So those are our panelists. I'd like to start this way with a quick setup. We have, at the beginning of the year, we have a man named Plotkin. He's running Melvin Capital. It becomes known that Melvin Capital has bought shares. I correct myself, he has sold shares short of GameStop. And there's a reaction to this. He sold the shares short on the presumption that the share price is going to drop. It becomes known that he has this interest in the shares. There's a run up in buying, and now the whole issue is out there in public. And I'd like to get the panel's take on how they see these initial developments. The hedge fund, as we'll see, ends up losing a lot of money. Another group named Citadel Capital comes in to save Melvin Capital, as it were. And so there's now a battle, but let's hear what our experts have on the take of what happened. And then we can ease into this question of why it happened. I'd like to start with Dory Wiley. Dory, you're involved in the financial markets. You follow them. What's been happening over the past 10 months? Dory, are you muted?
There we go. I apologize. Thanks for having me on this panel today with highly esteemed people today. It's an honor to be here. Well, I think when you first look back to what happened with these meme stocks and what meme stocks are, I kind of started looking at Tesla and a few stocks like that were widely invested by small investors. They became hype stocks. They became trend stocks. They became a way to kind of stick it to the man, if you will. We're going to run this stock out no matter what anybody thinks, because this has got a cult following. And then you start to see what happened with GameStop and AMC and Sundial, some of these others, where the opportunity for tens of thousands of investors to stick $100 into something that was immaterial and didn't mean a whole lot, all of a sudden could move a stock. And hundreds of thousands of these could not only move a stock, but it could fight hedge funds. And so rather than thinking that a hedge fund could make money on a distressed company, they could save the company by sticking it to the hedge fund and allowing the company to grow and even raise capital that in a company that probably didn't deserve to live. And so the word meme, basically, if we think about Elizabeth or Ron or I sending memes to each other on text, it means what? It's a joke. And that's the oxymoron here. The meme stocks are a joke. and they're hyped. And these they get hyped up on the internet, programs like Reddit, and people act together and you take a company that's going into bankruptcy or going broke or not doing well, and have them raise all this, and it gets all these short sellers to lose money in hedge funds. Short selling being, hey, I want to sell this at a big price and watch the company go broke and buy it back at a low price. So the whole industry out there is kind of rocketed. Let's call it distressed opportunists, and that could be in distressed credit, that could be in short sellers, that could be credit arbitrage where you're buying the debt and selling the stock short, expensive capital. All of this industry is messed up right now, and because you don't know, you can lose money in a company that is legitimately supposed to go bankrupt, in addition to the bankruptcy opportunities. And so what it does is it casts a shadow around other opportunities that aren't meme stocks, because the investors that are there to either help companies survive or encourage their failure for the good of capitalism are hesitant because they don't know if they're going to get rocked by this meme stock phenomenon. So there's a lot to talk about here, but why it happened, I think it's emotional. I think it's the old classic thing that came out of the 20s, and you see this on the slide here of the old investment trust, a fear of missing out, the opportunity to make a whole bunch of money, the musical chairs opportunity, and you're going to stick it to the man at the same time. So it's kind of created this cult phenomenon around an opportunity for small investors to participate in something. And actually, if it doesn't make money, it's not that big a deal because they're only stuck in $100.
All right. Thank you, Dory, for getting us started. We'll obviously keep everybody active here as we go. But Ron, what's your take on this? You've been involved in a number of the funds that correspond to hedge funds. Give us your perspective, if you would, as to what's happening.
Sure. I mean, if you step back and look at the Melvin Capital, that was the PE firm that invested in GameStop, I think at a high level, their investment thesis was likely, GameStop was built on selling games to young kids that are computer gamers, where they go to the store, buy a CD or game and bring it home. And so the investment thesis was, gosh, this is just like Blockbuster. I mean, industry's changing, this stock's got to go down because, they've got a bunch of retail store, a high cost of doing business, and technology is going to change that where people just load things down or streaming. And that was a rational thing to think about. And so they started shorting the stock, and it was down to $4. And then, this phenomena happens to where, almost I call it kind of gamification. I mean, when the internet accelerates things and accelerates information and accelerates the ability to communicate, and most times that's good. Sometimes that is not so good. And what it does is allow groups of people to simultaneously form. It's almost like a flash mob that forms. Instead of to dance, they do it to run this stock up. I mean, what they did is not really too much different than what we used to call pump and dump, where somebody would falsely talk a stock up in value, drive it to a high level, and to make sure they sold before the last person. I mean, if we can all say, gosh, isn't it wonderful? Somebody, sold this stock. It was a $4 stock, and they sold it at $400. But on the other side, somebody bought that stock at $400, and so there was money made and there was money lost. But this is a new phenomenon, the increased ability to organize and to influence financial markets. I don't think is going away. I think it's a phenomena of the communications acceleration, and it's likely to be here to stay. And what we're going to have to do is figure out ways to, when this is legitimate, just let it go. And when it's not, to have regulation and enforcement and all to catch people that are doing something that is not according to the rules. I mean, the purpose of regulators are to make markets that are fair and orderly. And maybe you can argue whether or not this was fair, but you certainly can't argue that this was orderly.
Thanks, Ron. This might be a good point for a good place for our first question on the, so Emily, would you put up the polling question number 1, please?
Yes, thank you, David. All right. Is GameStop the company based in Texas? Yes or no? And I'll give you a few seconds to answer that. Okay, it looks like everyone's participated in that. I will share the results. There you go, David.
Okay, so it looks like everybody's aware to some extent of GameStop, and it is a Texas-based company. I'd like to move to Gil because Gil has this perspective on what markets should be. And Gil, would you take it from here, please?
Yes, thank you. So good morning, everybody. Again, thank you for having me on the panel, and it's an honor to be here. I like to start with historical perspectives, and there's some of the things that we're seeing today in 2021 that we have seen in the past, and some stuff that both Ron and Dory touched on are new. And so we do have the rise of individual investors is actually not new. It comes in waves, and it usually comes with technology. So if we go back to the 1920s, we suddenly got these stockbrokers you can call and they'll buy stocks for you. And that was new, so everybody jumped right in. And we saw what I will characterize as a wave, people coming in and buying. And there was discrimination, but not that much. Everything was going up. Everybody was excited, and they're all buying, and it creates this wave. We saw again in the 1990s, suddenly you can go online and buy a stock on your own. But just click and you own a piece of Apple, Google, and other .com firms. And we saw it again. So the individual investors were flooding into the markets. And we saw that wave again of asset prices going up and up and up, and some of those .com firms that eventually did wind up crashing. And if you go up another slide, we actually saw the same in bubble, where basically everybody could get a mortgage, so everybody bought a home. We saw the same in those scenarios as well. And in 2021, you now have Robinhood, and you have children who are trading. In fact, I have kids around the age of 12 and 14, and their kids are active traders in capital markets. I can tell you, apart from the name of the companies that they're buying or the crypto, they have no real idea of what they're doing. And so again, this is the new technology coming in. You're buying stocks and cryptos and everything else on your phone. And it's almost like a game. And it's again creating this wave again of a lot of people entering the markets, and those individual investors that are rising and trading again in the markets. So if we can go one slide ahead, what is different in 2021? And I think both Ron and I should mention, here's a wave that we can see. So actually, I like pictures, and you can see this at the end scores between getting to 2020. Look at that rise in stock price really quickly. And that's what you're seeing, is this rise in Robinhood trading and the rise of just people honestly just buying everything. And this is the waves that we're seeing, and we're seeing it right before 2000, right before the financial crisis, and we're seeing the same now. As you can see, there's some starting a correction, I think, maybe. I don't like timing the market. I'm not sure anyone can really do that well, but you do see that there's a little bit of a decline in the last few weeks, and that's what's that red dot going down at the end. So if we can move forward, you could see what is different in 2021. As I said, Ron and Dory touch up on it. Coordination. So social media networks, and Reddit is the one that is famous in the case of meme stocks, but Twitter, Facebook, all of these platforms have allowed investors to coordinate. That's something they couldn't do before. In the age of the internet, they didn't have still in the 1990s very sophisticated social networks and everybody's connected, and they weren't able to coordinate. And the meme stocks are coordination. So again, I like showing pictures. If you go to the slide, next slide, as I said, my kids' age is 12 and 14. So every movie I see has some sci-fi in it or something space related. But I thought this is a great example of what's going on. So this is the Starship Enterprise, for those of you who are Trekkies. And it was, in the last movie, it was fighting all sorts of these small little firms. So you can think of the Enterprise as the hedge fund, and you can look at all that swarm as individual investors. In the movie, as in the meme stocks, these individuals were coordinated. When you have a coordinated swarm like this, the hedge fund is not the big player. It is actually the smaller one. And a very large group of coordinated small investors become the big dog in this environment. And that's what we're seeing in the meme stocks, where a company that should basically, it's Blockbuster. Basically, GameStop is Blockbuster, same kind of business model, same kind of problems. And rather than letting it die, these small investors decided we don't want to let that happen, and they took down the hedge funds. As I said, when they're coordinated, they're the big ones. And I'm going to stop here in the perspective, but I would say the word that I'm missing is the word efficiency. GameStop raised a lot of money, and this is where I think the costs are. It's not just that someone bought at 400. It's that the person buying at 400 and gave GameStop the money could have put that money somewhere else. Remember, capital markets, we're in a capitalist economy. Capital markets decide where the capital is allocated. And when we put all that money in a company that none of us, and I mean that most of the investors I know in GameStop, I know I had a student in one of the executive MBA programs, and I asked him, why did you buy? He said, it's sticking it to the man. And I was, but you don't think the company should survive? He's like, no, this is. And so even the ones investing in GameStop don't believe in the company. So this money could have been used to develop drugs, could have been used to create jobs in a new emerging technology, in a new business. And instead it's going down a company, which again, going down potentially a rabbit hole. And that's, I think, what is the cost of this phenomenon, is that the swarm it's not there to try and improve the way the market is working. It's aimed at destroying the hedge fund or the enterprise, as you see here in the picture.
Okay, that certainly gives
Can
us.
I add something to that right quick? I think Gil brings up a real good point about some of the costs of this, but I would also point out, because this has certainly happened to me in other areas of the market, when a company that is having trouble or needs capital, let's just say a company needs capital, and they raise capital, it's dilutive to the existing shareholders. They get less of the company. They get less of the earnings. They get less of the profits. So when you have a GameStop that raises $1 billion at a value that's 50 times more than what the company is probably worth, the existing investors get murdered. They got no chance of making money. Even if GameStop were to pull out of it and do terrific, they will still never make money. And it just kills the existing investors. So these people that think they're sticking it to the man, they're also sticking it to the people that had invested in GameStop to begin with, that maybe were trying to hold on and actually save the company and do the right thing. And so, or at least in their mind. And so they've got no chance. That kind of dilution, you have no chance of making money. And it's extremely destructive, as well as what Gil was talking about on the opportunity cost side.
Well, thank you, gentlemen. There's two negative views, if you will, to to start us off with. Let's bring Elizabeth in, and then we can begin to bounce back and forth on some of these issues. Elizabeth, your initial take on this?
Good morning, everybody. I'm honored to be here with so many esteemed colleagues, talking about something that I think we're going to see in lots of dimensions of society. I think the capital markets are just the latest place where the whole retail phenomena, the whole democratization of the finance world is going to see where the rubber and the road meet. You had a perfect storm at the time of GameStop. I don't think that was a new phenomena. I just think it was an opportunity at a moment in time for a number of forces to converge. The swarm, as Gil points out, is more of a norm now because the rise of the retail investor is going to continue to grow on the back of technology that has allowed anybody, anytime, to trade anywhere. And I mean, your cell phone is really all you need. That opening the door to the opportunity to essentially engage with Wall Street now has given the man on the street, Main Street, the power that Wall Street used to essentially be much more dominant. Institutional investors, as we know, are primarily made up of investors like us, individuals, in their pension funds and in their retirement accounts and any number of other areas where we do active investing. But now at the individual level, we've created an opportunity where individual stocks can be traded, such as children or adults or pretty much anybody who wants to get into the business of savings and investment has access to Wall Street, thanks to the likes of the Robinhoods and others who have opened that door. As many of you know, we're also experiencing a change in the way we think about everything because of digitization. So the digitization of finance, I believe, is going to take us to a brave new world. We've seen that phenomena with the rise of cryptocurrency, the fact that we have digital capital in multiple forms that we can now monetize in the form of digital assets. We have other areas where these changes and these dynamics are opening the door to new business models, which in turn open the door to new innovation. So when Gil speaks of, the challenges in allowing a herd mentality to take over activities such as investing, we then see that there's going to be a reverse dynamic, which will be that the corporations and those for whom these stocks are being traded are going to have to rise and essentially meet the challenge. GameStop was a wonderful case study because they saw an opportunity to do two things. Number one is to get close to their customer, who in turn defended the company essentially from the activities of the hedge funds. And on the flip side, AMC, who was also at the same time another one of the meme stocks, was able to raise capital at extraordinary valuations on the similar premise. So with the opening of the door of 20% now of the activity of Wall Street being tied to retail investment and that area growing, I think this phenomena is going to continue into the future. Technology is really going to change the game and has changed the game. And I think that's the area that we all need to spend a lot more time understanding. This is a challenge for the regulators, especially because if you can pump and dump or do something that simulates a pump and dump, essentially now you've opened the door to a market that is no longer efficient potentially, or is able to be co-opted into areas that basically distort the results. And to Dory's point, I think it's critical for us to understand the valuations under these circumstances and understand the effects of what happens when we allow the gamification of something as important as investment.
It seems my panelists have at least three questions being raised here. There's this question of new investors, and there's this question of who has the real power in financial markets. there's also this issue of new investment patterns and new assets. This might be a good place for the second question, because I'd like to investigate who these new investors are, have a little bit of a push on that. Could we have the second polling question, please?
Yes, David. Okay. Robinhood had about how many monthly active users at the end of June this year? 5.3, 21.3, or 75.4? Just a few more seconds. All right, we'll end that and share the results.
Okay, it shows a somewhat of a split here. The actual answer is the middle one, the 21 million rather, as of June. Now, it's consider the rise in this, the number of this. So I'd like our panelists, if they would, to talk about this new investor again. It sounds like some of the panelists think these new investors are just in for the for a game. Is that really the case? Where I'm coming from on this, hedge funds have tremendous power in this country. To talk about a bunch of teenagers able to overturn them sounds kind of far-fetched.
Hey, David, this is Mark. There's a comment on the chat as well that kind of goes along with what you're saying, in that in the Reddit posts, there were all of this swarm, these unsophisticated investors, but there were some sophisticated investors as well. And in particular, this person brings up AMC is that a battle of a hedge fund versus another hedge fund, where one of the hedge funds is trying to use this, the novices within Reddit and so forth on these memes as leverage. Maybe that feeds into part of your question there as well.
It does. So let's put it to the panel this way, and anyone that wants to pick this up, please take it. The question is the relative power here. Has the power really shifted, or are we just seeing a temporary phenomenon, as Gil had alluded to, that's happened sometimes in the past?
You know, I don't think it's that simple. And there's some comments here on the questions on the chat. It's not necessarily small investors against hedge funds or small investors against big investors. You know, even though the perception of these small investors is, hey, we're sticking it to the man. It doesn't work out that way, right? Because everything's moving, everything's dynamic. So an opportunistic institutional investor or hedge fund investor may see a movement from the retail investors and jump on and accentuate or amplify that movement. Okay, so the meme stocks are active for traders. There are small traders and retail traders, unsophisticated traders, and they're sophisticated, and they can all be aligned if they see everything moving the same way. So you can rest assured that there were opportunistic hedge funds that were making money as GameStop ran up or as AMC ran up, as well as down. They're opposing each other a lot of times too. So the real question of the day then is, you know, if somebody was implying like, oh, you're advocating for the hedge funds. No, not at all. There are hedge funds that are oftentimes force good companies to go bankrupt when they shouldn't be, you know, and it's very frustrating. But the real thing, and a couple of you have brought this up, particularly Elizabeth, was stock manipulation. That's wrong. Stock manipulation, wherever it comes from, hedge funds or from retail investors, is wrong. And part of the problem with the SEC and regulation right now is they don't enforce anything. They don't enforce anything on the stock manipulation side. They have been quiet. They have been dead. There have been no consequences. There was clear, I brought up Tesla earlier. There was clear violation of existing SEC rules from the chairman of Tesla, CEO, and they let it go. Didn't let him do anything. Manipulating his stock. Okay, so how are you going to stop a swarm of small investors on Reddit? You know, they need to figure it out, because stock manipulation is wrong. And back in the 80s, when that happened with Ivan Boesky and all these other people, they got in trouble for it. And you know what? a lot of that stuff stopped. And this stuff will continue on as long as there's no consequences. But there is some natural consequences from the capitalist market system. You keep advocating for broke companies to go up 5 million%, you know, you're going to lose money, and you're going to get tired of losing money. I mean, a lot of meme stocks are all down 40% or more now. So if that keeps going forward, people will get tired of losing money, and that phenomenon will stop too. But hedge funds against small investors, I'm not really seeing it. Shoot, these hedge funds encourage the small investors to do this stupid stuff so that they can pump and dump as well. And they're just as guilty because they're manipulated.
Does sound it's a little more nuanced. Go ahead. I think, was that you, Gil, trying to come in?
No, but I'm happy to jump in. I'm not here to say that the hedge funds are okay either. The point of the discussion was about specifically the meme stock, which was driven by some investors that were manipulating stock prices as a game. But I'm going to mirror what Dory said. I think it's strong to manipulate the price, to knowingly have it deviate from fundamentals and misallocate resources in our economy, regardless of who does it. And I'm not advocating for the hedge funds industry and the asset management industry either, which in my view is also over consolidated. There's BlackRock is sitting on so many boards and deciding what firms, and you see the argument about corporate social responsibilities and all the investments that firms are required to make because BlackRock is investing in them. And if you polled actually individual investors, I'm not sure that you'll get a majority of investors wanting those investments. So I'm not here to advocate for any one of those actors. I'm just basically saying I think we're seeing a lot of, and that is different than in the past. I think we have a lot of coordinated movements, and we have a lot of hedge funds as well that have gotten big enough that have the ability, and just Elon Musk with his personality, have the ability to change the market prices or create distortions in our capital markets. And I think that's bad. It always is a bad thing. I go back to market efficiency is extremely important in a capitalist system. It allocates, it decides how we're allocating resources. When we're playing with it just to, as a game, we are losing something very important. And that means misallocation of resources. It means less growth, less jobs, and it's an overall cost. I'm not here for advocating one group or another. Again, hedge funds do short squeezes all the time, just because they know there's an opportunity, not because they think the company should survive. And I think that's what Dory was saying as well. And I agree with that. When you manipulate the stock prices for whatever reasons you're doing it, I think there's a cost to it. And I'm not advocating for that. It's not that I'm advocating for one group versus the other.
Okay, we seem to have some agreement, for want of a better term here, on who the new investors might be. There's been some questions come through the chat, and I'd like to raise it too, about hedge funds. Could we go to the third question, please, Emily? And that'll set us up. I'm going to ask my panel about hedge funds.
Okay. All right. Do hedge fund managers expect to take losses some of the time if they sell corporate stocks short? Yes, no, or unsure. This one's going fast. Okay, I will share that poll. There you go.
Okay, as we can see, the majority of people, 80% of us, think that they expect to lose money some of the time. Now, Dory talked about the hedge funds, but I'd like panelists to speak a bit more about these hedge funds. The hedge funds as a community have tremendous power, don't they? Let's investigate who's on the other side, quote, of this issue. Ron, would you care to come in?
Well, hedge funds are not popular for many reasons. I mean, if you look at a sophisticated portfolio today, so much of it in recent years has slipped into passive investments, the index funds, exchange traded funds, such like that. And the amount of traditional managers that you have, that piece of the pie of the investment policy has shrunk. The piece of the pie that hedge funds have has expanded dramatically. And at the, definitionally, hedge funds are there to take advantage of special opportunities. So some portion of your portfolio, I can understand being in that, but we're way out of whack with how much money we have in hedge funds. Gil talked about that today. We're just way out of whack with how much money we have in hedge funds because some of them are delivering better returns than your index funds. Now, some of them aren't as well. There's above the line and below the line. And the other thing that's distortive in the thing is the fee structure of hedge funds is very positive to the managers, far better than a managed fund traditionally has been, or a mutual fund, or all the other ways that you invest. And so there are individuals taking out significant personal fortunes because they're running these hedge funds. So hedge funds are not popular from any stretch of the imagination, but this phenomena of the meme stocks and such, with the retail investor being 20%, I mean, as a portfolio manager, you can't ignore this and say, this is going to go away. I mean, you've got to be both defensive to this and opportunistic to this. I mean, at some point in time, somebody is going to start a hedge fund to specialize in situations precisely like this. And some allocation of your portfolio has to be into the things that retailers are, or the retail investors are playing in, because there's money to be made and money to be lost in those. But a smart investor says, gosh, whenever there are active markets and prices are moving, I need to have some portion of my portfolio allocated to that. So I think this type of activity, unless there's significant regulatory changes, is going to continue happening. And it's going to be something that, as a smart investor, you have to figure out how to play in this.
Elizabeth, would you speak to this point? All of us on the program believe in free markets somehow. I mean, we have this principle of free markets, admittedly regulated, but aren't these developments, won't they sort themselves out?
Well, I mean, David, we've seen a phenomena that I don't think any of us have really focused on thus far in this discussion, which is markets have really become volatile, and they become volatile in short intervals of time, and if you think about the volume that's traded and the amount of, wealth that kind of changes hands and the amount of dry powder even right now that a lot of our investment community is sitting on in terms of making investments, and this is now global, we've changed the game. I mean, volatility is an opportunity for making, or for profitability and for the traders and for a lot of folks, and that's your opportunistic moment. I think what's happening is in the retail side, they see that these short burst situations where you can move price, or you can change, if you will, the opportunistic landscape, then people want in on that. I think that they're just, what we saw with GameStop was they were just mirroring a strategy, but on the other side, to match the power structure of the hedge funds making similar moves. I mean, I don't think that you really have anything more than that going on here. Hedge funds are a fact of life. I mean, they have been around a long time. Their strategies are well defined and well known. Many of them specialize in specific industry sectors and keep those sectors efficient at many levels. Capitalism is not perfect, but I believe that when markets are, fair and open, and actors act in the interest of, creating wealth and doing things by the book. I mean, as we would call that, the regulated book, although Dory makes a brilliant point about the fact that our regulators have not quite figured out a lot of this, and don't know where to fit in the story as we continue to move more to the technological approaches. I mean, when you can have trades that literally move an entire market or shut a market down in a day, much less than an hour, or even, you know, in a short interval of time. And you've got significant wealth that could be created and lost, because it's zero sum within that period. You've got a more of a roulette table, or probably more of a Las Vegas approach to what's going on now in our finance world than anything else. The crypto world has also sort of, and I don't mean to, you know, sort of shift us into that world as part of this discussion, but I don't think you can ignore it. The crypto world has added a whole new element, because people have seen where, you know, a $2 investment is now worth, you know, $50,000, $80,000 per unit. I mean, it's getting to a point where we've got crypto millionaires, and they're all under the age of 25, many of them. And God hopes they're paying their taxes on their transactions, because you can't, one thing in this world is you can't avoid the IRS. So I still think that, you know, when we think about the hedge funds, you know, they're not hated as much as people are looking at that strategy and saying, you know, how can I get in on that action? And I think that's a lot of what we're seeing is Main Street is starting to try to mirror Wall Street. I think the most startling view of the day that the GameStop phenomenon happened was that young man, I think he was at MIT, who paid off his student loans in less than a day and held up, you know, his profit on a sheet of paper. And you know, that was, I think, as much of an influencer to others seeing opportunity as anything else.
This, let's somewhat shift gears to the dimension that Elizabeth is bringing up here. If we were to step aside and say, has the investment pattern for individuals changed? Could we address that? I'm thinking before we got here, we had professional management. We could always ask the professionals to manage our investment for us, or we could be an individual, and the conventional wisdom was we would invest in index funds and we could manage that sort of thing ourselves. Have we moved to a new world where it goes far beyond index funds, but we could still manage things individually? Or rephrased, will this personal investment market change? I guess it goes to you, Dory. You're as involved as anybody in these kind of topics. How do you see it?
Yeah, we manage money, and I would say the answer to your question is yes and no. How's that? How's that for hedging?
Good class.
You know, the more things change, the more they stay the same. You know, the best investors tend to be long-term investors, you know, like Fayez Sarifim or Warren Buffett, or, you know, you have the long-term outlook. And then markets really haven't changed. You know, they're irrational in the short term, they're more rational and fundamental in the long term. So you kind of have to have a long-term outlook. What's long-term? 3, 5, 10 years, 15 years, you know, but 1 to 3 years, extremely risky. Now you get into trading, and the more you trade, the more risk you're taking, whether that be an institutional hedge fund or whether that be a small-time investor. It is very, very difficult. It's about momentum. It's about luck. It's about timing. All those things are really difficult and really not fundamental to long-term return. So in the long term, fundamentals tend to win out. Right tends to win out versus wrong. Things tend to smooth. And so I would say the differences really haven't changed a whole lot. That's always been that way. And really good managers, whether they be individual or institutional, perform that way. There are many underperforming institutional investors, and the reason is why? Because they're run by people. And emotions affect people, emotions affect investment. And people, are, whether they're institutional or individuals, are susceptible to hype, to trends, to culture, to fast profits, to greed, and to fear. And one thing that has not changed is greed and fear not only rule the markets, they rule the world, and that's how things are done. And that's very, very fundamental to investing.
Elizabeth, do you want to come back on this briefly? You got us into this. Maybe things are different for the individual investor. Do you want to comment?
Yeah, I think we've got to understand whether, a swarm is a norm. I mean, individuals are going to seek opportunity. I mean, the fast payoff is something that I think the regulators are going to have to start paying closer attention to, because what we're seeing is, people can make significant sums of money in very short order based on these aberrations or these activities, if you will, that are going on, whether it's short squeezes or it's some other, run up in value, or even the SPACs. I mean, we could talk about, that phenomena that was sort of parallel pathing what was going on with the, with the whole meme phenomena starting back in January. I mean, stock markets are right now at an all-time high. I mean, not just in the US, this is global. So I think one of the challenges is that, and there's so much capital sitting there on the sidelines. It's a world of opportunity, and people are realizing that money never sleeps, and that's a way that they can build wealth. And that's going to, as I said, change the game for us economically, as well as in the way we think about Wall Street and the whole phenomena of raising capital and seeing economies built from that capital.
Thank you. Gil, if I'm guessing, my guess is you're going to say that the individual investment market has changed. Maybe I'm wrong. You want to speak?
So I'm actually gonna be closer to Dory. Yes and no is in the short run for sure. Yes. I'm gonna go back to history because that's my research as well. We've seen things like this. This is where we have seen this before. So people have in the 20s, in 1990s, people were like, well, we can build wealth on our own. We can mirror what the hedge funds are doing. And they went in. And the story ended when they had to get out because there were distortions in prices as a result. And what happened afterwards is, again, the hedge fund industry to some degree rose from it because the individual investor says there is money to be made, but I don't know how to do it. And I don't have even if I do, I don't have the time to invest in picking the winners or losers every year. I have a job. I can't spend all my time. And let's say I have a big investment account of 500,000. The added in returns that I'm going to make, I just rather pay someone who's going to manage 500 million and pay them a fee, and they'll do a better job than I will. So that's kind of how the hedge fund and the active management came to be, is when they lost. So I'm not willing to say how things will change again. But after the 90s, we had all these, the index funds have exploded as people saw the hedge funds losing money. So we will have to see over time if a lot has changed. Financial markets hasn't necessarily completely changed. And I think when the dust settles after all of this, we'll be wiser in terms of what have actually changed in the long run. The one thing I would say, and I've heard a lot about the regulators and adding regulation, and again, I'm extraordinarily cynical, so I'm going to warn everybody right now. Market regulators tend to be, they work on incentives as well. And what many cases happens is the ones that are whispering in their ears are the ones with the most amount of money. And we might get regulation that actually squashes the small investors while allowing hedge funds to have the bad behavior. I'm not necessarily sure that would be the outcome that we're interested in either. So again, I want to have free markets, but I think again, the freedom comes with responsibility. And if we're all trying to responsibly, just trying to make money and trying to choose the winners and losers, and we play in that way, we'll have the best markets out there. If we start also trying to manipulate, and I'm not here on each side, or whether it's the individual investors of hedge funds, we'll just have worse markets, worse capital markets, and worse outcomes. But I'm not necessarily a fan of regulation. I think we know how that's going to be lumped up and which side's favor.
Thanks. Ron, you want to take a whack at this? Here's my question. Middle-class investor, got a $2 million portfolio. Are things going to change for me?
I think they should. I really think they should. I think this is going to be a part of the market, and you got to figure out a way to participate. Doing it, going on, taking a little different perspective. I've coached a lot of CEOs of companies that go public, and I tell them, you know, before you were a public company, you just had to run your company, be innovative, grow revenues, do all the things that makes a very valuable company. Now, as a public company, in addition, there's another layer of intangibility over that, and that is making the analysts happy, because you will have a small number of analysts, usually from half a dozen to a dozen, that are extremely important in what they write about your company. And you've got to talk to them. You've got to make sure their expectations are ones that you can meet, and meeting their expectations and all. This is the way you keep your stock price up. So you've still got to run your company, but you got this layer of intangibility with the analysts. Now, I would coach a CEO of a company to say, in addition to those two, there's one other level up there. And that's particularly for a CEO of a company that has a product that consumers are aware of. And you have to figure out how you position your company in this whole, space of the Reddit followers and the Instagrams and the Facebook and this whole social media thing. You need to be aware as a CEO and to be active in getting your company positioned as well as possible for those things. I mean, you can't ignore it. You cannot ignore it. You as a CEO could be a part of this, and they could play on you in a positive or a negative way. As a CEO, you've got to cope with those things. So I think a CEO definitely has to cope with it. And in a parallel, so does an investor. If I have a portfolio and I'm a portfolio manager of UT Dallas's endowment, for example, you've got to figure out how to play in this sector. This sector is moving. People are making money. The stocks are volatile, as Elizabeth said, but you got to figure out how to play with it. I mean, ethically, I'm on Gil's side. I want efficient markets, and this is not efficient. But there's money to be made here, and in general, you've got to play in areas where there's money to be made.
All right, let's poll our audience and see how they feel about efficiency. Emily, could you give us question 4, please?
Sure. Okay. Is it important to have efficiency in financial markets as part of the capital allocation process? Very important, somewhat important, or not important? All right, we will end that poll. Here are your results.
Okay, everybody sees this. 83% say it's very important. 4% say it's not important. I'd like to go this way in getting comments on efficiency, because we've got financial executives, financial managers on this call. We all know something about finance. Ron, let me go to you first. What does efficiency mean to you one more time? And how do we get it if it's important?
Well, as an economy, the best way our economy can progress is if we put the capital to the most productive uses. I mean, that's the statement of intent that you would have. Now, in practice, what that means is that companies that are going to innovate and make products that make businesses more efficient, make life better for consumers, make health better, I mean, those are the companies that as a society, we should flow capital to, because we're going to get back hundreds and thousands of times more benefit from that capital we put to those innovative companies than if we play in other companies and games. So an efficient market, I think, don't think of a trading market. Think of a level of tangibility above that. Think of a capital allocation market. I mean, if we can allocate our capital as a society to companies which will innovate and improve the lives of society, then we're going to be far more successful. And I think that's what we should endeavor to do in an efficient market.
Okay, maybe you set this up nicely. I might follow on. I'm going to ask Gil and then Dory to comment on this. Ron seems to be distinguishing between a trading market and a capital market. I'm tempted to ask here, can we run them separately? I mean, do we have to be concerned for the capital allocation market? Could you pick this up first, Gil?
So again, Ron and I think are symbiotic on our conceptual of what we're thinking. And I think that I agree 100%. We just want to have the best allocation of resources. And I think financial gains in the trading markets will set us aside on that. It will basically get us further away from that efficient capital allocation, which is something that will all wind up. Again, we all gain if the allocation is better. Now there's mistakes happening all the time, but the good thing about markets, they correct mistakes. And hopefully, again, we want them to correct fast. So that's the point of GameStop when it's still a losing company. We don't want money flowing into a losing organization without a vision. And that's one of the comments that came in. The company doesn't have a vision of turning this into a profitable company. In fact, I'm not sure anyone has a vision of turning that one into especially GameStop. AMC, I think, is a little bit different, but GameStop, I don't know if anyone has a plan to turn that one into profits. And that's a lot of money that just went into that company that as an economy will not see again. And that's true everywhere. It's the difference between these markets and the publicly traded ones and the ones that are, it's much more difficult to play games within the smaller VC markets and with illiquid stocks. And in these capital markets where everybody can, as we said, use a cell phone and become a trader, there's a lot more games to be played. And I go back and make the statement as if we all turn towards it, fundamental analysis, where should the money go? Where is it going to do the most amount of good in creating returns, jobs, opportunities? If we all move to that, I think it'll be great. And I think there'll be the best outcome.
Dory, could you pick it up this way? You earlier talked about manipulation and said that was the bad part, the evil, if you will, in the market. Not your term, but that's the direction you were talking about. If what's needed on the regulatory side, is that the answer to the question that the previous two speakers are talking about?
Well, it kind of plays into efficiency, right? And the efficiency question is really a lot more complicated than saying, you know, we want capital to flow the most inefficient areas that make the market more efficient. Well, or make the best use of that capital, right? So if markets were 100% efficient, you know, then, you know, that's not something that can ever be achieved, right? Because there's not perfect knowledge and not perfect pricing. Inefficient markets create opportunities. Inefficient markets create opportunity. You know, so that's why private equity funds have the best probably risk reward of all the asset classes. They're private, it's illiquid. There's more information that can be done. There's added value. And then the next step is hedge funds, you know, maybe a little less added value, but still on the information edge side and inefficiency side. Where we get into trouble is manipulation. You know, whether a public company or a private company, anytime you're manipulating something, there's no honor in that. You know, that happens a lot when there's opportunity to do so and there's not regulation or oversight to do it. A purely efficient capital market will correct manipulation over time, but it's helped along with regulation. You know, the more regulation you have, the less capital markets you have, right? So it's always been a balance. I think there's room for more regulation here on the manipulation side, where that comes from institutions, which I think have gone unchecked, as well as to some of this hype and swarm meme stuff done on Reddit or wherever. Now, one of the panelists says, "Oh, don't blame the kids, blame the Fed." Well, you know, we can blame the Fed for creating an environment of over liquidity and overinflated values, but I don't think we can blame the Fed for starting rumors on Reddit. You know, they're not advocating a broke company like GameStop. And let's face it, GameStop's broke. You know, somebody made the comparison to Blockbuster. That was absolutely correct. It shouldn't be here. So giving them $1 billion is a complete waste and inefficiency. Now, another panelist talks about, well, what about privatization of public companies holding longer versus public? Well, there's been something created on that that's really the opposite of efficiency than inefficiency. Well, what the heck do I mean? Well, used to, smaller companies could go public, and the market becomes more and more efficient, then the smaller and smaller companies could go public. And now we're finding it going the other way. Bigger and bigger companies on the private side at more hyped values, and then they go public. So what have they found out? Why is that? And it's a really interesting phenomenon. It's starting to happen and spread outside of technology and other areas. And what they found out is if you keep it private longer and you hype it up longer and you create a track record of comps, of valuation, then when you take it public and you do it more and more times, then the public will buy it. And they're almost like chump buying. Okay. Also, I have this company that's worth, 500 times revenue or whatever, and we go public with it after it has a $10 billion valuation versus a $500 million valuation or 100 million. That sounds more credible. And we're able to push that out on the public. And then if we take our big investment bank and we keep trading the stock and keep it up for a while, all of a sudden it has credibility and everybody believes it's worth something. But that gets back to Tesla, right? At 312 times EBITDA. If anybody in their right mind thinks it's worth that, they're crazy. It's not. How long can it be hyped up like that? Long time. That's the old adage, right? The market you can go broke faster than before the market rationalizes itself. So this inefficiency thing is, I think, real important to the market because that's how you can make opportunity, but it plays itself out over a long period of time. If somebody defines efficiency as the capital markets working smoothly and trading this, that, and the other, I think some of that's kind of messed up because we don't have the regulation that we need to.
Elizabeth, can I change gears slightly here? You're active in the National Association of Corporate Directors. What are the corporate responsibilities here or corporate opportunities, whatever you want to pick up? But let's look at the corporate side for a moment. And Ron talked about the CEOs.
Sure.
Opportunities.
There are a number of issues that
Yeah, go ahead.
Yeah, okay. The situation with corporations is very interesting. And I think, Ron, you started to touch on a very important point, which is for corporations, this capital is based on their opportunities for innovation if they use the capital wisely, if they invest it. It's R&D specific for them, whether it's in the form of M&A or they're going to grow through investing in new factors of production or whatever else. In today's world, so much of value in the enterprise is intangible. And I think that's sort of changed because we're dealing in a world more of IP, intellectual property, and in areas where there aren't the old measures that we could look at to define what the value should be ascribed to be. And that's where this valuation question is continuing to be a real challenge for most corporations. Those that are publicly traded do have a responsibility to manage risk. And one of the things that we're not seeing enough of is in the boardroom, these discussions regarding stock price volatility, the opportunities that come with that, or also the risks that come with that. It was interesting in the case of both AMC and also GameStop, because of the run up in value, they were able to raise capital at a very attractive basis, and also it helped a number of their employment, investment funds essentially come into the money during periods when prices actually allowed options now to vest in the money, and workers who'd spent long careers at corporations where that stock value was lagging are now able to benefit from the so-called sticking it to the man. So there's upsides and downsides, but I think Dory, brings us back to reality with the argument that, if you're out there trying to raise capital and you're also looking at markets that are not efficient or are manipulated or otherwise challenged, then you've got to deal with that in terms of, your own backyard, if in your share price and in your shareholders and in the analyst view of your world, because the fundamentals are no longer the fundamentals. I mean, at the end of the day, there's nothing fundamental anymore about the fundamentals. And we've seen that time and time again with these, share prices that don't reflect the underlying value of these enterprises. And I mean, it's a very unique period of time that we live
Well, hey,
in.
forgive me on this, Elizabeth, but just to chime in here, I'm back on that corporate director responsibility. I have a fiduciary duty to make money for my shareholders.
That is correct.
Okay?
That is
And
right.
there's a perception out there that, hey, if I'm GameStop and these idiots are pumping my stock up to a worthless value, I have to raise money for this company to keep it to survive. And
Well,
that is not true.
No,
Your
you're
job
right.
is to raise money if you can make those existing shareholders more valuable.
Well, and
That's a disconnect.
Yeah, and that raises the point that I think, David, I'll tie two things together here. CEOs are now, especially for the retail companies like AMC, they're now looking at their customer as a possible shareholder. In fact, those two worlds are starting to converge in a way that I'm not sure is actually going to be a good thing. And one of the loyalty of your customer is now being translated into loyalty to the company, which means loyalty to, them being investors in the stock, and they're giving that away as well. I mean, there was the joke about, free popcorn with your, with your stock investment in AMC. And that's not a joke anymore. Recently, the CEO of AMC was talking, he's doing a lot more polling, and in fact, was talking about Dogecoin or Dogecoin or however it's pronounced. It's pretty dodgy from anybody's perspective, but that he was willing to take it, seriously because of feedback he had gotten from polling, their customers and their shareholders. The rise, when you have 80% of your stock being held by retail investors, you have a different relationship to your owners. And Dory, I'm really curious how you see that, because that's the world that's changed, right? It used to be the analysts would be essentially the proxy for helping the institutional shareholders sort through the financials and understand, kind of the horizon of what we're looking at of long-term growth and value for the enterprise. But in today's world, all bets are off, especially if you're in the retail sector, where you can develop those very important relationships with your customers and translate that into commitment to the company, as we saw with GameStop.
Well, that's easy, right? If I'm the CEO of AMC, what have I got to offer you? I can offer you a return. So I can offer you a culture, a feeling, and some popcorn.
Ron, you've been a responsible officer in some pretty big corporations. What's your take here on corporate responsibility or opportunity?
Like I said, I don't think this is a passing phenomena. I think the fact that retail investors are going to be there, and they're 20% of the market today. I bet you that's going to grow. I bet if you look at millennials versus people my age, you're going to see a radical difference in how we invest our money. So for corporate responsibility, you've got to look at how your investors, how people make a decision to invest in you, how often they invest in you, how often they hold for the long term versus trade and try to flip it and all. You've got to be cognizant of all those things because your share price rewards your investors that stay with you for the long term. Your share price rewards your employees, and your share price allows you to continue to give good service and good products to your customers. So you have to work that share price angle. And I think you're going to have to figure out a way to work these markets. It's just something that we're going to have to do. We have to realize, particularly, and everybody has said it, companies whose product is visible to consumers, they're in a different category. A company that's business to business, way in the back office with a very esoteric product that you don't understand if you're not deep in an industry, those are likely to be protected for this phenomenon. But anybody with a product that is out there for customers, you have to be aware of that. And as a CEO or as a director, you've got a responsibility to deliver for your shareholders. And if you don't work these markets, if you don't work this stuff, you're not fulfilling that responsibility to deliver for your shareholders.
Okay, thank you. We'll see what shows up on the chat in this. I'd like to ask the panelists, there's been some discussion in the chat about monetary policy. Now, Dory, you said it wasn't the Fed's responsibility if we had different kind of actors chasing stock, but there was a serious question. There are serious questions in the chat here. Maybe there's been too much money floating around looking for too few assets, and that's the cause of our problem. Do you have any reaction there?
I think it does create an environment to do so. Anytime there's free money or low cost money in an environment, things get overheated, things get over leveraged, and things like this with the meme stocks, tend to happen. So I do think it creates a culture of it. I don't think we can directly say the Fed's involved in hyping meme stocks. Of course not. That doesn't make any sense. That has its own causes. But they are responsible for creating an environment of this loose policy. Now, having said that, is it more the Fed or is it more a monetary side or the fiscal side with Congress? And a lot of money's coming out of Congress. Okay, and now they're looking at another $3.5 trillion that we flat out don't need. We don't need it. We got enough money flying around out there, and you could argue we already have a trillion or so more that we didn't need to begin with. So there's plenty of money out there. There's plenty of low accommodated rates, especially in an environment where there's some signs of pretty strong inflation or at a minimum transitory inflation. We need to let the economy absorb what's going on without all this monetary intervention. The Fed has a big problem on the buying side, as it will. The Fed buys a third of all bonds. Now just let that stick in your head for a little bit. A third. They've got a wolf by the ears. They can't let go. They want to taper, but there's the consequences of a taper tantrum, which is if they let go, even say 3% out of that 30%, there's going to be a massive effect on the market. And any losses in the bond side are going to create losses. And those are leverage, and those create capital issues, and it's all magnified. So the Fed wants to let go. It's going to have a hard time letting go. And as long as they're buying, they're doing the opposite by easing, right? Buying is trying to tighten. It's going to be very difficult. And so, throwing more money in on the monetary side, I just think is a massive mistake. And yes, we have a lot of inflated value in the market. We have some areas a lot more inflated than others. But at the same time, we could argue that what they did on the fiscal and the monetary side was extremely productive during COVID compared to what we did in 08 or even worse in the late 80s, early 90s. Why so? It happened immediately, and all that PPP money was in good hands. It went to people, it went to consumers, it kept the banking system. It was like manna from heaven. The banks had a lot of capital, but they didn't have a lot of liquidity and deposits, and it created probably the biggest mass of disruption of customers in the banking industry, from large banks to small banks where they actually could get some service, that we've seen in our history. And it was incredible how good it worked. And there's not a lot of talk about that. Not a lot of talk about that for a world that shut down. So I'm not going to criticize that a whole lot, but I am going to say I'm not sure we needed all the stimulus they gave us, but and we certainly don't need more. But it certainly creates an environment for leverage and inflated values.
Just to, I'm sorry, was there a follow on here? No, okay. I'm going to ask Emily to put up question 5 and then ask another question of Ron right after this around technology. Go ahead, if you would.
Sure, David. Do hedge funds drive financial markets toward efficiency? All right. Okay, I will share that poll.
Wow, that is a surprise for me. I don't know. Anybody have a comment on this one?
You know, I wonder, I would like to get, you know, hedge funds by design are supposed to drive the market towards efficiency because they're trading. So why people would say no would be interesting. My guess is it would be part of it's the stick it to the man, or I hate hedge funds, or maybe it's the knowledge that over the last 10 to 15 years, the performance hasn't been very good, especially relative to the fees, as Ron has talked about. But I'm really shocked that the no number is that high, because by pure definition, you know, they do and are designed to drive the market towards efficiency and take advantage of efficiency, but there's no reason for them to exist.
Any view, Gil, just as we pass through this one?
I agree that by design they are meant for that, but I have to say, as I said, I'm not unsympathetic to some of the views of some of the hedge funds, and some of the asset managers have gotten too big and too powerful, and they're actually, in my view, driving sometimes inefficiency within the markets, and as a result, you know, in many cases in operations. I'm not, as I said, I think you know, I'm hesitant on regulation, but some companies, in my view, within the financial world, are too big and too powerful, and that allows them the ability to manipulate markets or make decisions for investors when that's not their intended design.
Ron, I said I'd come to you with a question on technology. The question is this: looking to the future, will we see more technology that will be more disruptive this way? I have the feeling it will, but I'd like an informed opinion on this one. Aren't things just going to get, if you want to use the expression, more intense this way? We'll see these kind of disruptions and changes?
Absolutely. I mean, whenever you accelerate the flow of information, you achieve some good things, but you also introduce volatility and unpredictability and such in markets. I mean, if you think of social media, societally, they are a relatively new phenomenon. And it takes a while for everybody to realize, you know, you look on Facebook and you say, gosh, everybody's taking elaborate vacations than me. And everybody's eating these dinners at these elaborate restaurants than me, you know, because anybody, you know, and everybody has a great family life and their kids are achieving these terrific things, because all you see on social media is the positive things. Nobody says, oh, I screwed that thing up and got fired at, you know, my job today. You know, I picked this restaurant and the food was terrible. I mean, you don't see the downside, and it's the same in investing markets. The flow of information in a hot market and in a market with a lot of money, David, as you talked about, what you're going to see in social media is going to be 90% positive about everybody making money. But for every person that made money, somebody lost. But they aren't posting that on social media. I was a dope and I invested in this stock and, lost, $200,000 today. Nobody's going to make that post on social media. So as a society, the new technology comes in and it takes us a while to learn what's really happening out there. Because on the face of it, it's all positive, but you got to be not as a cynic, but as a realist. You got to say, I've got to take that social media in and I've got to discount it somewhat because the midpoint of where reality is not as good as that. And it takes, a long time for society to adjust to new technology. This happens over and over and over again. I mean, the digitization of the stock market happened a long time ago. I mean, we used to quote stock prices in 32 1/8, as a stock price versus $32.14 or something like that. And so once that came in, there were opportunities and some people took advantage of it. So I think technology always is disruptive. It's chaotic. And it takes a while to adjust. That's what Dory's talking about with Tesla. We've got this new technology of electric cars, and it is disrupting it. I mean, to have Tesla valued more than Ford or General Motors, I mean, you'd sit back and you scratch your head and you say, gosh, I don't know if that's really going to hold for the long term. But there are advocates out there that say Tesla is going to destroy the industry. And new technology does destroy industries sometimes. It really does. Not every time, but sometimes it does. And so it's always disruptive, I think, David. You're asking about the technology. The answer is there's going to be chaos surrounding a segment of our society when new technology is a big player in it.
Well, that's encouraging. Going to be chaos.
Absolutely.
Can I jump in on this one, David?
Please do.
So one of the things I think this audience needs to pay attention to is there's an emerging area called DeFi, which is essentially the digitization of Wall Street. And it's a movement that is gaining quite a bit of traction, partially because of the whole NFT and crypto kind of influential elements that have helped to define that area. But when traditional financial institutions start embracing these alternative technologies and these alternative digitized finance worlds, then you'll see a brave new world for Wall Street. And that's where we are today. Looking at countries that are now trying to recreate their whole economies on the back of technology and digitization, that is something, to be followed. We also have a new category of people that I think also bear, some scrutiny, and they're calling them financial influencers or finfluencers, if I've got that statement right. The Wall Street Journal just wrote a piece about, the average Joes being market movers now, or gaining followings of large swaths of people, and they're not even sophisticated people in the form of those that have been industry experts or anybody who follows any type of regulatory background. I mean, the financial world is a licensed and a regulated world for a reason. And we have, with the Securities and Exchange Commission, disclosure laws and things that are there to protect the investors. And yet we're in areas of social media, violating a lot of those parameters. I mean, Dory, you and I have been at this when we started on Wall Street together, 30 plus years ago, and watched, Glass-Steagall and changes that happened that allowed the concentration of power now to, rest with financial institutions that are now defined as not even financial institutions anymore, because they deal in so many different areas of finance. Once upon a time, everybody had a swim lane. Private equity was an asset class with its own swim lane, and investment bankers, and you had supply side, and you had buy and sell side, and everybody had a role. But today, a lot of those things have converged. I mean, you take a Blackstone, or you take any of these large financial entities. They're no longer just doing one thing, they're doing all these things, and their concentration of power and wealth has pretty much been another day of reckoning, because that also has been an important part of the market story, along with the FANG issue, which none of us have really looked at. But the biggest market makers, the most valuable stocks in the market today, are the FANG stocks. And that is your Facebooks and your Googles and companies that 20 years ago really didn't exist. I mean, Amazon 20 years ago was nothing more than a bookseller, I believe, a fulfillment house, and today is one of the most valuable companies in the world. So, there's a lot going on here, David, to unpack when it comes to technology, digitization of finance, markets, and value. So I just bring that out as just yet another, set of things for consideration. But the game has changed.
I want to pile on to that for a second, because there's a comment on here and a question. Hey, these so-called unsophisticated Reddit investors are giving the hedge funds a taste of their own medicine. Again, you guys come across as being very sympathetic to hedge funds. It's amazing, the anger out there. It's just amazing. Now, having said that, so when we go back to that question, right, which is, do hedge funds drive market efficiency? By definition, they do. Okay. Now, are there exceptions where there are dishonorable hedge funds? Absolutely. There's a bunch of them. So let's get into technology right quick and this digitization thing. If any of these people, if you've read Flash Boys, it ought to make you shake in your shoes. And that book's been out for a while now. And what's that about? That's about interrupting and intercepting what I think is illegally and front running order flows. And there are big, massive quant shops and hedge funds that do this, and the regulators don't do anything, right? Think about how bad that is, right? So that's not me advocating for hedge funds. That's against hedge funds, dishonorable ones, and they're out there. My point is, and I said this from the very beginning of this show, is the SEC is not active enough. Okay, there are people that invest wisely and honorable, and there are people that don't because they go unchecked. And there's a lot of that in the market, and that tends to happen during the 1920s, during the 1980s, during the late 90s, and it's happening right now. I'm not advocating for that. I am 100% against it, and I said that from the beginning. It needs to be regulated. There needs to be more and it's not just in the meme stocks. It needs to be in a lot of different areas. And we have an SEC that has gone silent, totally silent. There's a question here: is payment order flow a good thing or a bad thing? Depends on how it's working. In general, I think it's kind of bad. It's front running, right? These people are paying no commission on Robinhood. These little small investors, hey, I'm sticking it to the man and I got free trading. This is great. They're getting hosed by Citadel. They're getting hammered by Citadel because they're paying too much for the stock, because Citadel's front running them on the order flow. And these people think, hey, we're doing great, noble things. You're getting taken to the cleaners, and it's not honorable. And then guess what? It's by a hedge fund. Okay, I'm not advocating for them. Okay, so this release of anger through sticking it to the man and GameStop and through Robinhood may make you feel good, but you're getting chomped.
Thank you for that. We have a question coming up, Dory, that fits in perfectly with what you just said. We're
Hey,
going to
David,
yes.
I'm sorry, there's a question on the Q&A page as well, and it kind of goes back to that hedge fund efficiency question. Do you mind if I throw that out real quick?
Could I ask this, just to follow through with Dory, then I'd ask you to come back in, Mark, and we can talk that one through.
Okay.
Emily, could you throw out question 6, please?
Sure.
we'll interpret this area as meaning what we're discussing this morning.
Does this area of finance need more regulation? Yes or no? Just a couple of more seconds. Okay, we will end that poll and share the results.
I guess I agree with you, Dory.
Maybe we ought to have a question now is, will it get any more regulation? Yes or no? And I think the answer would flip to the negative side.
Thank you. Mark, do you want to come back on your point, please?
Well, there's a couple of things in the chat, and one in the chat and one in the Q&A. I'll go through the Q&A real quick. If hedge fund managers' responsibility is to maximize returns for their investors, and hedge fund returns have significantly trailed S&P 500 for the past 10 years. Well, I just lost the question. Hold on, here it is. How isn't this inefficiency being introduced by hedge funds? They charge fees to their investors and produce far inferior return over the long haul.
So I guess the question is, they're paid for stuff that they don't do?
Well, saying the returns have trailed the S&P 500. So how is that introducing efficiency when their returns are lower than the S&P 500?
Well, first of all, the S&P 500 may or may not be the benchmark for that fund. Depends on what kind of fund it is. But the implication is the same. If it's underperforming its benchmark, then it shouldn't be in business. People shouldn't invest in it. And there are hundreds of, if not thousands of hedge funds that shouldn't be in business. And there are hundreds, if not thousands of hedge funds that have failed or gone out of business the last 10 to 15 years because it's become more and more difficult for hedge funds to perform, which is great. That's the way markets should work. It's pretty difficult to trade and outperform the market with 2 and 20 fees. Very, very difficult. And, only the best should survive. So I'm all for getting rid of them. What I don't understand is why people would invest in them if they can't perform over the long term. So many people will invest in hedge funds that with short-term performance, thinking that they're brilliant when over the long term they can't do it. And it takes them a while because of ego to recognize they made a bad investment and pull out.
Just to warn our panelists, warn's not the right word, but in about 5 minutes panel, I'm going to ask you to summarize your feelings and to react to what you've heard this morning. Elizabeth, we were on a similar program and we had Gary Kusin, who was the CEO of GameStop much earlier. You have some reactions and remember his reaction to discussion of GameStop and what happened. Could you react to that, please?
Sure. I mean, Gary, first of all, he founded a company called Babbage's, which eventually, grew into what was then GameStop, and clearly has known the history from day one of and the changes in both the strategies as well as the opportunities that came with building that company during periods of time when technology changed, when markets changed, when consumer experience with gaming changed radically. I mean, gaming is a tremendous phenomena that continues to evolve. Gary's point of view was, he thought it was a very unique moment when leadership of these companies were at the ready, when the share prices ended up with a run up, that many of them had shelf filings or literally had the opportunity to raise capital at a moment's notice because they had done a lot of the diligence prior and were prepared to do those offerings, and clearly made those cases to their shareholders at the time and gained full support. I mean, I was just looking back on GameStop from the period of January to present. I mean, the share price hasn't fallen too badly during this period, and even AMC, which took an even more wild stock ride, that deal was wildly lucrative for their CEO as well as for their employees and those that are participating in profit sharing plans with the company. You know, in Gary's mind, it was nice that, you know, the profit sharing that was able to, you know, be paid at the time that the share price went up was, you know, helpful to many employees who for years, you know, were not able to monetize that value. So, you know, there's good sides. I mean, there's positives, there's negatives. You know, when AMC, you know, I think it was back in June, they, you know, the stock-based compensation for a lot of the people was quite lucrative. They were going to be rewarded, you know, I think it, you know, when you deal in these areas where you have pay for performance, you know, this is not, you know, something to be trifled with, because that is how you incentivize folks to build companies for value. And I want to just touch on real quickly this question of regulation that just came up before, David, before we lose the thread. You know, when you talk about the regulators in today's world, and especially when you talk about technology and you talk about social media and areas that you're going to have to start policing, you know, within this whole issue of market dynamics, you're also now talking about the FCC, the FTC. You're talking about other entities that normally wouldn't be, you know, dealing in capital markets or dealing in the financial institutional world, that are now going to cross in and have to reconcile all this, you know, these dynamics, all these challenges. So I just find it, you know, we live in interesting times because when we talk about the need for more regulation, the question is who's going to do that and how are they going to coordinate, because you're crossing so many different lines. I mean, AI right now can affect markets probably more dramatically than any hedge fund can. So, you know, you want to talk about price manipulation and talk about real-time transacting. You know, there's another area that I think you know, needs a lot more scrutiny.
Final
Hey,
question.
David,
Yes, sir.
one of the things that was brought up in a couple of lines on the chat to Elizabeth's point there on the federal involvement was the federal government bailouts and buying into these companies and then holding them, turning around and trying to make a profit that way as well, or not a profit maybe, but at least their influence along with all of those agencies that Elizabeth just mentioned. What impact there, good or bad, or neither,
Well,
would that be?
I invite the panelists to roll this into their discussions. I see them as being somewhat different. It seems to me you've got a public point of view there that is, or public perspective that is much more pronounced than in the meme stock area. But I'd invite anybody want to respond to the question that Mark is raising that. Sure.
Well, Elizabeth and I first met each other during the banking crisis in the late 80s and early 90s. And, you know, this is a really, really good question that has got a great answer. Okay. So I remember in school when I first learned about deficit spending units, you know, of a municipality, which would be like a bus line, right? And buses don't make money, but should we have them? Right? So they're subsidized by the city and with bonds or whatever out of the general budget, but they're deficit spending units. Okay. That's pretty easy. Yeah, we need buses. People can't get around. It helps the city become more efficient. Or we need a rail line in the city, same way. Well, you take that to other extremes. Well, do we need General Motors and Ford? Do we need that manufacturing here? Do we've only got one or a few coal manufacturing cities here? Do we need that, or do we need to lose them and depend on China for coal? What about airlines? You know, is that a public good as well, or should we bail them out? Bob Crandall used to say, who used to run American Airlines, never invest in an airline. It's a horrible business. He's probably right. They get a lot of help from the government. Why? We need them. It's good for the economy. Banking. You know, banking is the plumbing and wiring for the economy. Now, the problems exist. We can use banking as an example. When you go too far, you know, there were in the 80s, there were a lot of steel-toed boots that came down to Texas and said all Texans are criminals every bank should fail, let's throw them all in jail. And then when you had these rolling problems through other economies, particularly when it got to the Northeast, all of a sudden the regulators went, wait a minute, let's do forbearance. Maybe everybody's not a crook in a bank. Okay, so they did mixed rules, didn't apply to the people. Big transfer of wealth from the South to the North, biggest since the Civil War. Then what comes around in 2008? Forbearance. We're not going to prosecute anyone. When I first met with the director of the FDIC, they said, yeah, we're going to go after boards of directors of failed banks and stuff because that's our job to go after monies on behalf of the taxpayer. Somebody intervened, no one was prosecuted, even when there was wrongdoing. It was too lenient. What about all these big giant companies countrywide and whatnot, and big giant executive bonuses of millions and millions of dollars for a failed company? I'm not for that. That's terrible. You run a company in the ground. You lost money. You don't get a bonus. That's crazy. So they went too far the other way. So it's a real gray area where I think in some industries you need some government intervention. The question is how much? And that's when it gets political, and that's those with the biggest grease and the biggest megaphones win sometimes. And sometimes there's not enough of an advocate for the little guy and the taxpayer.
Thank you, Dory, for answering it that way. Let's go to our question 7. We're approaching the end of the program. Our question 7 will take us back to how we started, really. Emily, please.
All right, thank you, David. Would you ever consider investing your personal funds in a meme stock such as GameStop? Just a couple of more seconds, guys. All right. We will end that poll. There you go.
3/4 say no. Okay. Gil, could you start us as a good accounting professor here? We're beginning to wind up. You've listened to the program. You participated in the program. Thank you very much. What are your concluding thoughts for us?
So actually, I'm with the panel that I think certainly the rise of the individual investors is probably somewhat permanent, but I would warn everybody, if you don't mind going back 2 slides up, we're making conclusions when the market is high. The dust hasn't settled. And we won't know, as I said, if you go back to the late 1990s, people were saying all sorts of things. They changed their firms to a .com to make money for the investors, and the share price went up, and and then the crash happened, and things gotten a little bit back to normal. So we're going to find out as things go back. But I'll conclude with the question about GM and the government making investments. To me, that goes to the exact point of what we're talking about, efficient capital markets. The government is not an official capital market. A lot of its investments are basically stuff we shouldn't do, and they're making it on our behalf. And going back to, again, regulation, which I think, look, financial markets have to have them. I just want to caution everybody, and I know there's like a lot of anger at hedge funds. The regulation and the regulators are going to get whispers in their ears, and it's not going to be from the Reddit users. And I don't know if their added regulations would be leveling the playing field or making it more uneven towards one side. I've seen too much of this movie going back and forth. And when the regulation comes out with all the good intentions and it winds up with terrible outcomes, I'll give Sarbanes-Oxley as an example. We, as a result of it, have shrunken our financial markets. It has limited my access to companies. Uber was private for a long time, even though I knew it would succeed much more than it did. I wanted to invest in it. I couldn't get my money into it. In the past, we would have, because it would have been public. The cost of going public was lower. People went public. So the idea of the Sarbanes-Oxley was to protect and help people like me. It wound up costing me. So, and again, the accounting firms made a lot of money for a short period of time. There's other people that gained. I'm not sure I'm the one that gained in the end. So, and I just am very You know, I can hear a lot of the anger about some of the hedge funds, and in some respects, I actually share it. I think the games have not been played fair. The government investments and their bailouts have been related to, and you can see political connections, and that's been on both sides. I don't view this as a partisan statement. Sorry, so that's a nonpartisan statement of how governments in many cases work. And I think that's something that hedge funds have done in a long period of time. Also, again, a lot of hedge funds have started playing rather than doing fundamental analysis and figuring out when I was wrong and make smarter investment. What so many of them are trying to do is figuring out where I'm going to go wrong, even convincing me to make the mistake and then funding me. That's not something I want them to do, and that doesn't encourage efficiency. But that is also related to the rise of the individual investors. The more hedge funds you'll have out there, the more sophisticated investors you have out there. It doesn't have to be hedge funds. As long as even the individual investors, as they become more sophisticated, you'll get less of that activity because that won't be lucrative. So I'm going back to my original point is if we all start acting responsibly and we try and fundamentally figure out how much the value is of that stock, should I put money in it? Is it a good investment? If we all play in that game, we'll all have a much better outcome than the manipulation and regulation and everything else we're trying to do. I'm not necessarily optimistic that we'll see it, but I'm always hopeful.
Thank you, Gil.
Thank you.
Ron, you want to give us 2 minutes, your final thoughts?
Yeah. Well, Gil had the right point, which is in bull markets, individual investors rush to the market. And when those markets turn and become bear markets, they're the first to run away, and they stay away for some time. And when the market turns back to positive, they miss that initial run up. It happens over and over again. But that said, I think individual investors doing the things that, making decisions on the information they get from Reddit or Facebook or other social media companies, I think they are a force that is going to stay here. And to the question, David, that everybody just answered of, would you invest in GameStop? And everybody pretty resoundingly said no. I would agree with that as a personal investor. I wouldn't invest in that. But when I see a hedge fund formed to take advantage of these type situations generally, who is going to put professional expertise to focusing those situations, that's a category. And in my investments, you want to be diversified and you want to play in every category. And I think this is a category that's going to be there for the long term. These types of opportunities, they're financial opportunities, and they don't do a lot of good for society or economy in general, but there is money to be made. And I think as a category, as a smart investor, you put some money into a category.
Thank you. Thank you for that. Elizabeth, your views, please. Final.
Sure. On the issue about would I invest in a meme stock, be careful there, because AMD is a stock with very, strong fundamentals, became a meme stock overnight. And, Palantir is another stock that's been talked about as being a meme stock, and there's a real business there as well that has in many instances, we could all say has a very bright future. One issue that I think is going to become very important as this retail environment continues to grow and the democratization of finance continues to happen is that there needs to be a lot better financial literacy and a lot more of an understanding about what are fundamentals in today's world when you have these market dynamics and you have these technological shifts and you have these new products and these areas where markets can be influenced, manipulated, or whatever the particular distortion might be. It's got to be a fair system, and at the end of the day, that's really what we hope the regulators will do. But as I stated before, your regulation has changed so dramatically. I mean, when AMC acknowledged, its skyrocketing, share price at the time when their run up happened, that it had nothing to do with its, current state of its, that its stock performance had nothing to do with any of its fundamentals. And they put that actually in their offering documents. You got to take a step back and say, where are we in all of this? I mean, that type of absurdity of disclosure of saying, you know, hey, it is what it is, and you know, you can lose all your money tomorrow. You know, we need to come up with a better standard for how this is going to play out, especially as it relates to you know, financial disclosures and the regulatory side. You know, personally, I love innovation. I've been involved in venture investing over the years. It is good for the economy. It is important for the economy. And, you know, we've seen a lot of efficiencies in finance, especially now that it's global. But we are looking at a market at an all-time high. So it's very hard at this moment to really take a step back and understand, you know, where the weaknesses are and realistically where the risks are. And you know, Dory being the good financial investment manager and advisor and you know, person who studies markets by being in them every single day, you know, I'd be really interested in your last thoughts, because you know, we are all in this for the long run, and you know, we're going to see a lot of disruption, and it's going to take lots of different forms. That's why, David, you and I spend our time with the Center for Finance Strategy Innovation looking at those dynamics and doing programs like this. So I just want to say thank you, you know, for allowing all of us to weigh in on this today with FEI.
Okay, we're going to give Dory the final swing of the bat. Go ahead, please, Mr. Wiley.
First of all, thanks for having me on here. It's been a great discussion, and one we could probably go on and on with. So, and it's a great group and not lacking for opinions, which is great. Regarding that last question, I think we have to be careful about trying to pigeonhole stuff. You know, there's meme stocks, but what's the dividing line between a meme stock and a momentum stock, or an overvalued stock, or a pump and dump stock? These things have been around forever. It's just a different name, right? It's the same thing. So at some point, it does get back to fundamentals. What is overvalued and what isn't undervalued? And that's in charge. I don't want that regulated. That's the investor's job, either be it the individual or the institution. I don't mind that. I don't necessarily mind the meme stocks, but I do mind, you know, the pump and dump manipulation. I'm just not into manipulation. That's bad. So it does get gray out there when we ask, you know, would you ever invest in a meme stock? Well, if my job was to be a momentum trader, that's a clear momentum trade, and it's easy to see and trade and follow. Okay, and you can make money on it. You make some money and you get out. I'm not necessarily, I don't do a lot of momentum trading. I don't have time for it. I do a lot of long-term investing. I don't know that I could advocate and say, you shouldn't momentum trade. That's a science, that's an expertise, and it's a legitimate business. You know, and so, you know, Ron talks about new funds being built to invest in meme stocks. I would say there's old funds to invest in. They're called momentum. They're long only, they're hedge funds, there's others. They do it a lot. And I guarantee you'd find every one of them investing in GameStop, piling on. So I just think we have to be careful about trying to label things that have maybe been around for a long time, many years. Really appreciate being on today. Thank you, David.
Thank you. I want to thank, first of all, our panelists and FEI and the university. I think collectively, we've helped financial literacy in this area. I really do. This has been a big contribution, laying out some of the issues, not necessarily coming up with all the answers, but really helping literacy all the way around. I have 3 sentences trying to summarize what I heard this morning. These are changing times and it's unclear what will happen. That seems to be a given. Efficiency is important. We all believe it's at the center of our financial markets and we want to keep it. And the third point, corporations will change somehow as they cope with the new environment. So that's my takeaways. And again, thank you to all. Emily, it's your platform at this point.
Go ahead, Elizabeth.
I want to thank everybody for being here and the over 50 plus attendees that came and the 9 panelists. Thank you to each of you. This was a very informative presentation. I totally appreciate it. And this does conclude our summer series for the 2021 year. And we're looking forward to presentations next year and the technology breakfast the first Tuesday in December. So looking forward to see everybody back again. Presently planned for in-person.
All right, thank you. Thank you for participating on today's webinar. You should receive a email in about 7 to 10 days regarding your CPE. This does end our webinar, and have a great day.
Thank you all.